I'm Jenny Brown and welcome to this week's edition of MFB News. I hope you're all really well. Hope you've had a great week, that it's been kind to you and everything is super duper good with you. What have we got for you for this week? We're going to do our usual roundup on what's been happening with the lenders. There's some interesting kind of moves at play at the moment in terms of where pricing's going. So it's going to be quite interesting to discuss that with you. And then what we're going to do is take a deeper than usual look into what's going on with house prices. So for those of you who are thinking about investing this year, really to give you a greater understanding of how the market is expected to play out over the next 12 months. Okay, so what's been happening with the lenders? So it's an interesting time. As we've talked about in recent weeks, we've started to see swap rates increase, and this is on the back of a nervousness around whether UK inflation is really as under control as we think it is, based on the Eurozone realising that their inflation was really running out of control, and also the US realising that core inflation was continuing to go up despite their overall inflation coming down. So this means that both those regions are going to have to put up their interest rates quite aggressively, and as we all know, if the US pushes up their interest rates, there's a lot of pressure in the UK to also push our rates up to keep our currency strong. So what this means is that actually, whereas people were expecting base rate to only maybe go up by a further 0.25% in March, so we're now in March, aren't we, 1st of March, so yeah, this month, actually there's a strong possibility that interest rates might have to go up further. So this has really kind of added nervousness back into the money markets, and therefore fixed rate pricing has started to bubble up again. So what we've seen in the last week is some lenders push up rates, but also another whole swathe of lenders bring rates down. And I'll go into why that is in a moment. But first of all, what's actually been happening? So first of all, we've seen interest rates go up from MT Finance, Clydesdale Bank, and a couple of other lenders. And we've also seen the mortgage lender lower their rates. So they've actually brought their rates down. So they have got a 5-year fixed rate. 5-year fixed rates start from 4.64%, but these have the really big fees. More realistically, rates from 5.25 with a circa 2% fee. The mortgage lender are a specialist lender, limited companies, large portfolios in the background, no maximum number of properties, that kind of stuff. So really strong offering from the mortgage lender. Great to see them bringing their pricing down. Now, interestingly, I was having a chat with someone really senior there just before they brought out their rates, and they were saying to me, we're going to bring our rates down later this week, Jenny. I said, gosh, I think it's a really interesting time to be doing that, because obviously your cost of funds is going up, the swap rates are increasing. And he said, look, you know what, as a lender, we are just not getting the levels of business in or new lending in that we would hope. So what we're prepared to do is essentially bring in lower rates, take a haircut on our margin, at least temporarily, just to kind of try to drive up new business volumes. So there's a bit of insight into kind of, how the lenders are thinking, their behaviour, and some of their motivations as well. Now, we have also seen Vida Home Loans bring down their pricing. So 75% loan to value, their 5-year fixed rates are from 5.29. They have 80% loan to value rates from 5.79 and 85% loan to value rates from 6.59. Vida are the only lender offering 85% finance at the moment. It's really hard to get there. Obviously, when we're doing a rental calculation, which is based on a stress test of 6.59, actually getting the metrics to work can be quite difficult. It works really well on those high yielding properties, particularly in the north of the country. Also can work well on HMOs, which Vida do lend on incidentally. Other strings to their bow, so they're lending to limited companies and individuals. They're very good with people with larger portfolios, no minimum income requirement. They can also lend to expats, and they also have a whole suite of products designed for people with varying degrees of adverse credit as well. Now, the mortgage works have interestingly reduced their rates. They've reduced pricing on limited companies, HMOs, and for those products which are for individuals with larger portfolios. So in the world of the mortgage works, we're talking about 10 or more properties. So limited company pricing from these guys, fixed rates are now from 4.44 and variables are from 4.49. HMO rates, their fixed rates are from 4.59%, and you can have in HMOs with the mortgage works either individually or in a limited company. Maximum number of rooms is 7. If you have 4 or less letting rooms, they're going to value it as a standard family let rather than as an HMO. So if you've got a 4-bedroom HMO, which if you were to let it as a family, the rents would be really low, then the mortgage works wouldn't be the right lender for you, because they're not going to factor in the HMO rental income. The minimum property value here is £100,000. They can go to 75% loan to value, and if you did want to apply for a mortgage with the mortgage works on an HMO, you do need at least 2 years letting experience as a landlord, or 1 year's experience letting an HMO. The other thing to note just with their HMOs, 1 kitchen only please, and also no more than 4 stories. Now also, like I mentioned, they've reduced their rates for landlords with larger portfolios. So fixed pricing here is now from 4.19%. This is for individuals with larger portfolios, not a limited company with a large number of portfolios. You just pay the limited company rates in that situation. Okay, so that's the mortgage works. We've seen TSB reduce their rates, pricing now from 4.64. Very, very standard lender, so nothing too racy. Maximum number of properties in the background is 11. No limited company lending. They do have an income requirement of £25,000 a year. This cannot be from rental income. It has to be from something else. So day job, your other trading, limited company, pension income, that kind of stuff, but not from rents. One of the things TSB are good on, they're very good on niche properties. So things like high-rise, ex-local authority, they can consider things over commercial, always subject to valuers' comments. So they've got a really strong offering, and good to see them bring their pricing down too. Now we've seen Skipton reduce their pricing. Their rates are now from 4.39. Again, very similar to TSB. I put them in the same kind of sort of bucket of lenders. So £20,000 a year income required this time. Again, can't be from rent. Maximum of 10 properties in the background. Now this includes any unencumbered properties. So TSB was a maximum of 11 mortgage properties. Skipton was a maximum of 10 properties. However, you own them. So limited company, individual, mortgaged or unencumbered. No limited companies, please. No HMOs, no multi-units, nothing fancy. Just good old-fashioned, traditional, very vanilla buy-to-lets. But in return, you get the really good pricing here. The thing I really like about the Skipton is they're quite flexible in credit scoring. So some of you may have applied for a mortgage in the past and simply not passed credit scoring with a lender. For no particular reason, it's not that you've got any CCJs or mortgage arrears or anything like that. You simply don't pass the credit scoring. And credit scoring is a very complicated thing. So with Skipton, what we find is they tend to be very, very happy to put applications in front of underwriters who will pull the credit file and look at it and say, you know what, actually, you know, there's nothing obviously wrong here. These guys look really super clean. They look like good payers. For some reason, it's not meeting requirements, so we can consider lending to them anyway, which is really, really nice. Now we've seen NatWest bring their pricing down, so their rates are now from 4.49%. Now NatWest have a lot of actually great features in terms of the things that they are prepared to take on. So these would include the fact that they have no minimum income requirement. They can accept up to 10 properties in the background. And again, that really does encapsulate most landlords. Their 10 limit includes any unmortgaged properties as well, just for your reference. Now, the thing that I really like about NatWest is that they are brilliant at properties which are over commercial. When I say commercial, I don't mean sort of over an estate agent. I'm talking about fast food outlets, betting shops, hairdressers, all the things that a lot of lenders tend to step away from. NatWest can consider subject to valuer's comments. So if the valuer goes out and says, you know what, actually this is above a Chinese takeaway, but we think that's absolutely fine. We don't think it will affect marketability both in terms of resale and letting. NatWest will go ahead, whereas some lenders will say, actually, we simply don't want that kind of property. We're going to decline. A couple of other things with NatWest that I really like. They do lend in Northern Ireland. Not every lender does, unfortunately. And the other thing is they can do total first-time buyers. So not first-time landlords, first-time buyers. They will work on an affordability basis. So essentially as if they were underwriting it as if you were going to live in the properties if it was your home, but they can consider them. So we often get sort of investors' children, I would say, is the big one. So parents are quite prolific investors. Children want to get on the property ladder. Parents have given them a sum of money. Children are quite happy living at home or in their rented accommodation in the city, but they want to buy something. So they go off and sort of invest in a different part of the country. We see quite a lot of this. NatWest are very, very good for the first-time investor and buyer. Now, lastly, we've seen Coventry bring their pricing down. So Coventry, their rates on variable are from 4.88 and fixed rates are from 5.3. I always say this, I really like the Coventry. I find them really easy to deal with. They're very black and white. There is a real space in the market for lenders who sort of have grey criteria, because this is where we can kind of add real value to clients. But for those people who are super straightforward, who don't need anything too kind of complicated in terms of the way their cases are looked at, they just need really good, fast, efficient service. Coventry are fantastic for this. So again, individuals only, no limited companies. There's 10 properties in the background. Now, one of the things that Coventry do, which is really, really interesting, So it's a maximum of 10 mortgage properties. They ignore everything you've got in the background, which is unencumbered, but also anything which is owned in a limited company as well. So for those landlords who might have a couple personally and then 15 in a company, Coventry is your way to get really, really good high street rates on the couple that you own in your own name. So that's the lender movement this week. Now I think what's important and what you might have taken from this is there's been a lot of kind of high street banks reducing rates, not a lot of the more sort of the specialist lenders. So apart from TML and Vida, actually everybody else has been sort of high street institutions who are lending off balance sheet. And I think this really kind of echoes around to what I want to say to you this week, my key message. So as we know, swap rates have been going up. So yesterday they were tipping 4%, so just over 4%. 1 month ago they were at 3.551. This is 5-year swap rates, by the way. So 5-year swap rates have increased by 0.5% essentially over the last month. Now, as I mentioned, this is due to concerns around inflation and whether we're going to have to put up interest rates, because the US are probably going to have to put up interest rates quite aggressively. So that's kind of echoed through to the money markets and caused some real nervousness, which means that we're pushing our fixed rates back up again. Now, what we're seeing is that some lenders have already had to react to this and push up their fixed rates. Other lenders, as we've talked about, are bringing their rates down. Now, as I've also mentioned, some lenders are putting their rates down and they're just prepared to take a massive haircut on their margins just to kind of try and kickstart their new business volumes. But a lot of lenders actually are not as reliant on the money market, so you're clearing banks. So those lenders who take in savers' money to lend it back out, these guys aren't exposed in the same way to the cost of funds on swap rates. So these are the guys who are able to continue to bring rates down, and they're not going to stay down forever, but they're not as they don't have to react quite as quickly, I think is what I would say. So the message here is very much this. The reality is that at the moment, fixed rates are sort of still easing down in some parts of the market, but in other parts they're starting to increase. This is the start of things turning. We've been here before actually at the start of last year, and we delivered the same message then, because I guess we just know how to spot these things and the warning signs. So at the moment, if you are in the market for a fixed rate, actually now probably is the time to act. We're still speaking to people who are saying, do you know what, I'm still thinking about it, I think rates are still going to come down. Now the reality is that maybe in the long term, pricing will be lower than it is now, but over the next 4 to 6 months, there's a very, very strong chance that at the moment fixed rates are as low as they are going to be, and they're going to start disappearing and going up. So if you are one of those people who has been waiting very, very patiently and commendably for rates to come down, know that they have come down and they're about to start going back up. That's my warning for you this week. So just to do a little roundup of where we are then in terms of pricing. So personal borrowing, straightforward properties, your variable rates are currently from 4.09, no doubt will go up again later this month. Is base rate going to go up by 1/4 or 1/2? It's looking more likely to be 0.5% this time around, unfortunately. 2-year fixed rates, 3.99, 5-year fixed rates from 4.39. As I've said numerous times before, there are lower interest rate deals, but these come with whopping arrangement fees, 7% of the loan amount, 5% of the loan amount. So what I've tried to do is find a rate which I think is kind of sort of sits in the middle, a more realistic rate. So let's be honest about it, probably circa 4.39, unless you want to pay enormous fees. Now in the limited company world, and also this would kind of largely echo onto HMOs and multi-units as well, and also those landlords with the really large portfolios, variable rates from 4.49, 2-year fixes from 4.5, 5-year fixes from 4.99. So actually the market is behaving normally insofar as we're looking at about a circa 0.5% loading for being limited company HMO multi-units compared to your very vanilla rates. Okay, now Home Track have released their latest UK house price index. And I always find this really, really interesting. I don't know why, but in my mind, it's a very, very impartial view on the property market. And there were some key things that came out of it I just wanted to share with you, which I just found really sort of, quite interesting. Obviously, I have a very big interest in the property market. So what they're saying is that annual house price inflation slows down to 5.3%, which is down from 8.6% last year. So buyer demand and sales volumes are 20 to 50% lower than a year ago, but slightly ahead of the pre-pandemic years of 2017 to 2019. Sellers are having to accept an average of 4.5% discount to the asking price to achieve a sale, which is the highest discount for 5 years as the buyer's market really starts to take hold. There's a broad-based repricing of housing underway. The UK house price inflation is set to move into low negative year-on-year territory by the summer. The market is still on track for a soft landing with modest price falls of up to 5% and 1 million property sales in 2023. So what we're seeing is that when we're looking at house price growth year on year, because house price growth years goes time and in the following few months was really, really strong, but things are slowing right down. We're just seeing that growth year on year softening. So if you said, oh, how have house prices performed in the last 3 months, you would say that actually house prices have gone down. But because we're blending over a 12-month period where there was a period of growth, over the 12-month period, things are still in the positive territory. But what this report is saying to us is actually we are expecting growth to turn negative by the summer. However, they're really expecting it to be quite a sort of small reduction, so no more than 5% by the summer. Now, what they go on to say, which I find really interesting, they're talking about glass half empty or glass half full. So what they're saying is that it is possible to take two opposing views on performance in the sales market. So the glass half empty view is to look at trends year on year, comparing this year to the red hot market conditions a year ago. The glass half full view compares the current market to pre-pandemic years to 2017 to 2019, when activity levels and house price growth were more benign and trading conditions tougher. So eventually what we're saying here is that you can keep comparing things year on year, but actually last year was an exceptional year. It wasn't a normal year in terms of the housing market. So actually what's probably more realistic is to compare things to pre-COVID, where we were classing as normal trading conditions, and see how things are faring there. Now what they go on to say is that our data shows demand from home buyers has rebounded in the first 2 months of 2023, but remains at half the level recorded a year ago. New sales volumes in early 2023 have also recovered, tracking the usual seasonal upturn we see each year, albeit 24% lower than this time last year. So again, comparing to last year probably isn't comparing apples with apples. So actually let's kind of take a broader view on the market and how it normally performs and where we actually are. So what they're saying is that the reality is that current market conditions are more aligned with the pre-pandemic years, with demand 8% higher and sales agreed up 1%. So actually, compared to pre-COVID, the market's actually in a positive territory. This is the more useful benchmark for businesses as they plan strategies and investment decisions now. The frothy market conditions of the pandemic years are well and truly behind us. Now, moving now on to supply levels. So slower sales and a steady flow of new supply have boosted the stock of homes for sale by over 60% compared to last year. The average estate agent office has 24 homes for sale compared to just 15 1 year ago. Now, I actually remember doing videos talking about this, saying, gosh, actually, the reason the housing market is going so, crazy is that there's so few new properties coming to market. So what we're now seeing is that there's more properties available per estate agency branch than there was a year ago, and significantly more actually as well. Now, what they're going to move on to talk about is where activity levels are really holding up in terms of the country. So what they're saying is, while overall sales volumes are lower year on year, they are ahead of the pre-pandemic years in the more affordable housing markets, such as the North East and Scotland. Now, this is because the higher mortgage rates have less of an impact on demand in lower value markets. In contrast, sales volumes in the Midlands and Southern England are up 9%, up to 9% lower compared to the pre-pandemic period. Sales are 4% above their pre-2020 levels in London. Far from being an affordable market, house prices and market activity have significantly underperformed the rest of the country since 2016. And this makes the capital appear better value for money, which is supporting sales. So it really just goes to show how different parts of the country are going to have different kind of impacts from the situation that we find ourselves in with interest rates. But the reality is, and this is kind of what you'll hear, I'm sure, talked about on different kind of news wires and forums, is that actually those areas where house prices are lower, actually if you had 0.5% interest rate to a mortgage of £50,000, it makes a fairly small amount of difference monetary to people's pockets. Whereas if you've got a mortgage of £500,000, obviously 0.5% is an enormous change. Now, what they talk about next is quite interesting. So house price indices have started to pick up the decline in agreed prices over recent months. A house price index is now registering modest monthly price reductions, which have dragged the annual rate of inflation lower to 5.3%. This is echoing back to what I was saying at the very beginning, that actually, because house prices are actually going down, it drags the average over a 12-month period down to 5.3%. They expect their UK index to continue to show small month-on-month price reductions over the next 2 to 4 months, as the soft reset in house prices continues, but by the summer we anticipate our index to be recording modest annual price reductions of up to 2 or 3%. And I think this is kind of the real moment that you guys will be interested in. So actually by the summer, we're expecting house prices to have softened. We're going to be into real negative territory here, and this is where you're going to start to see the bottom of the house price sort of dip, as it were. So no one's expecting well, a lot of people aren't expecting, I'm sure some people are, expecting house prices to fall below 5%, and by the summer we're expecting the reductions to be at 2 or 3%, so we're kind of nearing the bottom at that point. Now, they talk about on a regional basis, the annual growth rates ranges from plus 2.5% in London to plus 7.1% in Wales. The real weakness in price inflation is coming through southern England, where house prices compound the impact of higher mortgage rates on buyers. So again, just really echoing back to the point being that actually in those really high value areas, particularly the southeast of England, then that's where we're going to see the hardest kind of, or the slowest growth, maybe the highest fall, whereas those areas of the country which are much more affordable are going to be much more kind of protected from house price reductions. Okay, now the outlook, and I think this is also really important. So the housing market is adjusting to high mortgage rates better than many had feared, and it's welcome news to see more rates for new buyers now in the 4 to 5% range and even lower. Mortgage rates are unlikely to get much cheaper, but competition among lenders will remain strong and keep deals attractive for borrowers. Their view has always been that 4% mortgage rates are manageable and consistent with very low levels of house price growth or price falls in real terms. It's welcome to see evidence of greater realism from sellers on pricing to secure a sale. The gains made over the last 2 years provide a buffer that can be used to unlock sales, and it appears that this adjustment in pricing is uniform across the market by area and property type. All this points to reasonable levels of turnover in 2023, which will support business plans for agents, builders, lenders and investors. The industry can manage modest price falls so long as the impetus to move remains. Working from home, increased retirement and high migration all continue to stimulate and demand to move home. Cost of living pressures exacerbate those needs for some. If the market delivers 1 to 1.1 million sales in 2023 as we expect, then it will be a positive result. So, key messages there are, yes, we are still expecting house prices to come down. We will be in proper negative territory by the summer. Things are going to bottom out at circa 5% average across the UK. But actually, beyond that point, really, people are feeling the market will remain relatively robust. And that's me for this week. It's 7 o'clock in the morning, so I'm about to go and get a coffee. I feel like I need it and I've earned it. Thank you as always for joining us. We always do really appreciate you taking the time to watch these videos. We hope you find them useful. If you have any questions, please feel free to give us a call 0345 345 6788 or have a look at our website where you'll find lots and lots of really wonderful information. I will see you again same time next week. Until then, please look after yourselves.